Welcome back to Portfolio, everyone. Is Virgin Galactic a buy now? Currently being traded around $16 a share, this company's stock is down over 17% in the past 1 month. And if we take a look at the 12-month chart, they are down over 52% from that all-time high. So in this video, we're going to take a look at Virgin Galactic, do a full analysis on the company, and overall determine if we like it at their current price point. We're going to go over some analyst future expectations for the stock, examine some price targets for the next 12 to 36 months, and just overall evaluate their current financial position and determine if we like this company at that $16 price point. This is an extremely volatile stock. We've seen lots of ups and downs over the past year, and this is a company where there is a lot of high potential reward, but that is combined with a lot of high risk that they will actually not achieve what they're setting out to do. So this company is back on the radar because they have some most recent news headlines that show some kind of positive aspects for the company over the next 1 to 2 months. If we take a look at their 12-month chart, the stock is still up 54%, even including this massive decline we've seen after they peaked at around $40 a share. On the 52-week range, they are trading very close to that low end, and this company currently has a market cap at $3.73 billion. So what we're going to do is take a look at some news articles regarding Virgin Galactic, discuss their future plans for expansion, and if we believe this company is going to reach the price targets settled by analysts, and of course wrap up by determining if we like the company at that $16 price point and if we're going to buy in right now. So thank you for tuning in, everyone. I am the Gen Z investor, and every single day we talk about different stocks you can buy, overall stock market performance, and any other big stock market news and headlines. So please like and hit that subscribe button, and we're going to get right into the big news headlines about Virgin Galactic. So Virgin Galactic plans their next test spaceflight for October 22nd. They're doing 2 more test flights before they're going to send up their CEO and founder, Richard Branson, into outer space. So the first of 2 space tourism company test flights are going to help to complete the testing for their Spaceship Two spacecraft system, and each test is going to have 2 test pilots on board, and if these tests are successful, they're going to use these positive results to help send their founder, the billionaire Richard Branson, up to outer space, which will be kind of the kickstart towards getting that full commercial space tourism company on the market. Once they can get the founder up there on a space flight and everything is successful after a few tests, then they will start to open up the market and allow everyday consumers onto their spacecrafts and to take them on trips to outer space. So if we're really unaware of what Virgin Galactic is going to be or what they're trying to do, they're trying to be the first ever space tourism company. So what they're trying to do is take everyday individuals from Earth, take them on trips up to outer space and back. So a round trip flight from Earth to outer space and all the way back. Of course, this will not be cheap. The price tag for these flights is extremely high, but over time they're trying to reduce that as they can, expand, grow the business, and over the long term, they're going to plan to try to make it more affordable. So right now, their first goal is, of course, to have these 2 successful space flights. First one being planned on October 22nd, so within the next 2 months. And then their next flight is for the beginning of 2021. In that first quarter, they plan to fly out Virgin Galactic's founder, Sir Richard Branson, which is incredible because he wanted to be one of the first to go up for the company. Other big new headlines for this company is that they are doing a lot of good things outside of just working internally for the company. They are making new strategic partnerships, and they've actually come up with a new deal with NASA to help create an astronaut training program using their private technology. And another good thing is this company's management is also growing as well. They've actually taken one of Disney's ex-executives and made them their new CEO. So Michael is their new CEO as of July, and he was actually president of Disney Parks International. So he was responsible for operations, strategy, and commercial and experimental development of the company's parks and resorts. So of course, these 2 businesses are different. They now have a CEO which has lots of experience working with a multinational corporation. He was an executive of Disney, one of the most well-known companies across the world. So he has a lot of experience working in a very large, fast-growing company, especially with this operational, commercial, and experimental development that he did at Disney. It will likely turn over very well to Virgin Galactic. They've also done a nice job. They have made a new partnership with Rolls-Royce to help collaborate in the designing and developing of the engine propulsion technology for the Mach 3 commercial aircraft. And of course, Rolls-Royce built the engine for Concorde, which flew at Mach 2. So they have a nice partnership with Rolls-Royce as well. So this company is doing a lot of good things. They have partnerships with some of the largest space organizations in the world, some of the best engine and automobile companies in the world, such as Rolls-Royce, and they have a new CEO, which is hopefully going to lead to some positive growth moving forward. So they've done a lot of good things, a lot of good recent news headlines for the company. Now let's take a look at their future expectations. So we know what the company's trying to achieve. They're trying to do these test flights to get Sir Richard Branson up in the next quarter of 2021, which will be a big milestone. But what are analysts expecting? How do analysts view this company? If we take a look at Morningstar, which shows a quantitative report about their fair value per share, it actually shows that at their current price point, just below $16, Virgin Galactic is being traded close to a 30% discount, and the fair value per share is around $22.50. So they're showing that this company could be 30% undervalued at this current price point. And if we take a look at what analysts are expecting for future growth, they see an estimated 35% estimated earnings growth over the next 1 to 3 years. If we take a look, top blue line represents total revenue at their current point in time. Bottom light green represents earnings. So this company is losing money year over year. We are going to take a look at their financial statements. But you can see here, over the next 5 years, analysts are expecting rapid growth year over year. They're seeing top line revenue flourish, and they're seeing earnings almost come up to that break-even point within a matter of 3 to 4 years. That's incredible. For this company that is extremely young, they have so much high capital costs coming for them still moving forward because of the industry they operate in. It's interesting to see that Morningstar values them at a 30% discount. Analysts are expecting massive future growth. And now we're going to take a look at some price targets for the company over the next 12 months. First set of analysts, we're going to go over 3 separate reports, shows the average price target amongst analysts puts the shares at around $25.80 in a 12-month span, which represents a 62% upside from their current price point, which is absolutely incredible. So being traded around $16 right now, within the next 12 months, this analyst reports put them around $26 a share. If we take a look at a second report to get more than one idea, you can see here that this report from MarketBeat ranks it a buy. You can see 180 days ago ranked as a hold, but the company has been improving, and that overall analyst expectations and view of the company have been changing buy over the last 90 days. And you can see here a 52% potential upside in share price from their current price point. And this analyst expectations have shares around $24.25 in the next 12 months. And you can see here that analysts have changed their perspective. 180 days ago, so about 6 months ago, shares were actually at a 13% downside, and analysts are expecting now that the shares have dipped below that expected price point, there's a lot of potential upside for the company. So even though shares have been declining, over the next 12 months, analyst expectation for the stock still is kind of around that $24 to $25 expectation. And the final report we're going to take a look at shows an estimated price for the company in 12 months at $24, which represents a 50.75 potential upside from their current price point. So we took a look at 3 different analyst reports for price targets. We took a look at a Morningstar report that shows the shares as almost 30% undervalued at their current price point. And we take a look at estimated earnings growth of over 35% year over year. Analysts see a lot of growth potential for this company. Of course, there's going to be a lot of ups and downs. If we go back to the price chart, you can see here on the past 12 months, every person who bought around this point, around the $20 price point and higher, has seen so much ups and downs. They saw a rapid decline where their shares almost doubled in value. They saw all those gains disappear in a matter of weeks, and they've been in the red over the past 3 to 4 months. So this stock is extremely volatile, a lot of high risk, but analysts are still showing a lot of good potential for the share price over the next 12 months. And I like to take a look at those 3 different reports, a Morningstar report as well. So 4 different websites, 4 different set of analysts, and 4 different completely different reports, all showing somewhat of a similar perspective of a price target around that $24 to $26 range over the next year. Of course, analysts just use expectations. We cannot guarantee any future performance, and in no way are those, guaranteed results. But it's nice to see what analysts are expecting. Analysts base their investment decisions from their estimates. So if they all have these estimates of around $24 to $26 and the shares are being traded around 16, something to keep in mind if evaluating this company on your own. The last thing we're going to do is take a look at their financial statements. If we jump into their revenue statement or their income statement, you can see that over the past 3 full calendar years, the company's done a nice job of growing total revenue. They do not generate much revenue whatsoever. For a company valued at around $3.7 billion, in the past 2019, they only brought in $3.8 million of revenue compared to their market cap around $3.7 billion. Over the past 12 months, though, during this economic slowdown, this pandemic, they have seen revenue decline, only around $1.6 million in total revenue in the past 12 months. So overall, this company, of course, is still in the research and development stage. They don't really have any revenue generating activities just yet, which is why they're bringing in almost no revenue at all. If we take a look at net income, because the company isn't really bringing in any money, they are losing tons and tons of money each and every year. Of course, like I mentioned, this is a very capital intensive business. They need to use a lot of capital in order to actually grow, innovate, and expand. And of course, if you think about what they're actually doing, they're building commercial spacecrafts. It is not cheap to build spacecrafts like spaceships. Like this stuff is not very cheap to do. This is highly capital intensive, costs a lot of money, and if things go wrong, it takes a lot of money to research and develop and grow and improve. So this company, of course, is using a lot of money and burning through a lot of cash each and every year. And if we take a look at their balance sheet though, for young companies, the balance sheet is very important to take a look at because these companies who burn a lot of cash, if they don't have a lot of cash on their balance sheet, they won't really have anything to burn through. And that's how these companies go bankrupt. So of course, Virgin Galactic, from their cash flows, they are selling more shares every couple months or every couple quarters in order to generate the cash to sustain business operations. And they did do that a couple months ago. They did generate around $460 million of cash from selling shares on the public. But if you take a look at right now, they have around $415 million in total current assets. So $415 million, if we take out the total current liabilities, only $113 million. So they have a total current ratio around 4. So within the short term, I don't have much risk with regard to this company. Around a current ratio of 4, so they have enough money to, of course, deal with all the short-term total current liabilities very easily, maintain operations, and still have enough cash on hand to fund this high net loss industry. If we take a look at total assets, $491 million compared to total liabilities of $136, once again, a total ratio above 3. So another idea where this company, the balance sheet's not too bad. Of course, we like to see overall ratios improve, but at their current price point and at their current financial position, even though they are burning through a lot of cash year over year, balance sheet, I believe, can sustain them over the next 12 to 24 months. So overall, Virgin Galactic, an extremely volatile stock, a very high risk, high potential reward stock by every characteristic. This company is extremely innovative. They're continuing to grow. They're trying to pursue something that's never been done before, which is very interesting. And they're really the only very first publicly traded space flight company. So if you're interested in Virgin Galactic, you can see analyst perspective on the company. We took a look at their most recent news headlines, which I believe to be positive. And overall, this is a company where they're trying to position themselves for long-term sustainable growth. I think this is a very interesting company. For me personally, I will not be holding this company. Way too volatile, way too high risk for my current investment strategy. I personally invest in more stable dividend-paying long-term companies with a combination of some more powerful growth stocks. For me, this is not the type of company I personally invest in, but for those who are looking for more of a higher risk play, of course, this is one to keep your eye on. So is now the time to jump in? Well, if you like valuing Morningstar reports, which shows this company is at 30% undervalued, if you believe the company will hit those price targets set out by those 3 sets of analysts, then now may be the time to jump in if this is a company that you believe is a nice addition to your portfolio, and if you want to take the high risk with this investment. So thank you for tuning in, everyone. I am the Gen Z Investor, and I will see you in tomorrow's video.